Welcome to Econoday Unplugged. Each week, our expert team explains the relationship between economic announcements and market reaction. For over 25 years, Econoday has provided value for the investment industry, amassing a comprehensive, machine-readable database of global market events. Econoday provides solutions for macroeconomics, sovereign debt, agricultural commodities, and historical data, all delivered via API, XML, and HTML. Connect the dots with Econoday. Subscribe to the Econoday Unplugged podcast and go to www.econoday.com to follow market events.
Hello and welcome to Econoday Unplugged on Tuesday, the 6th of August 2019. Mark Pender is stateside and I'm Jeremy Hawkins here in London. Well, just when things seem to be calming down in time for the summer holidays, US-China trade relations have deteriorated to a new low. Hard Brexit risks risen to a new high, and tensions in the Gulf region are as unstable as ever. So investors are looking for safe haven again, which means gold prices have hit new multi-year highs, bond yields are falling, 10-year US Treasuries yesterday dropped to their lowest level since November 2016, and in the currency markets, the yen and Swiss franc are in demand, as interestingly enough has been some of the cryptocurrencies. Now, if we believe that the Fed, and for that matter, the BOE and ECB are increasingly focused on international economies, does this mean another round of monetary stimulus is in the offing? So, Mark, how significant do you think it is that the Trump administration has called China a currency manipulator? And should we now be thinking about a second successive Fed cut in September?
Well, when that happened, I was thinking to myself, I was kind of going through things before it happened. I said, I guess they have to call him it was all within the same day, a currency manipulator. And I swear the next thing I saw was, the administration declares China a currency manipulator. But there doesn't seem to be any teeth to it. It has always been something for years and years and years and years, something that is in the background. Every 6 months they do these currency things. This is the Treasury. And it's always a threat. It's always talked about at the time, and nothing ever happens with it, except for this latest occurrence, and which is, something for history, a real flare-up in the war, and really showing that they're going to new weapons. And of course, this really opens the door for selling treasuries. They can, China's 1.1 trillion Chinese accounts holdings of these treasuries are going to go up in value because of not only the demand in the bond market, but for the strengthening in the dollar and the weakening in the yuan. So, and that data lags by quite a bit. So to see what they're doing right now, Chinese accounts will have to wait several months. But that is a real risk, I guess. But there's demand for treasuries is so strong anyway. Maybe it would do more than just slow the rise in bond prices. But what do you think? I've been thinking for the last week or so, the Swiss franc is bound to go up. The Swiss franc is bound to go up. Was that a sure bet?
Well, yes.
And what can the Swiss National Bank do?
Okay, well, I think we made warning noises about this just a few weeks ago, because as the Eurozone started to slow down, and so speculation has grown about this potential ECB rate cut, or at least some form of ECB easing, and now the market's determined that's going to happen once we get to the next central bank meeting in September. Of course, the poor old Swiss National Bank is stuck there with already negative interest rates. Its key policy rate currently stands at minus 0.75%, but with the prospect now seemingly of ECB interest rates going negative, markets are starting to look around and think, well, that's narrowing interest rate differentials against the Swiss franc, which means perhaps we should start thinking about buying the Swiss franc anyway, because it's the safe haven currency. And because of all this latest turmoil in the currency markets in general, as a result of yesterday's developments, of course, people will tend to buy the Swiss franc simply because of its safe haven status in the first place. Now, what can they do? Well, to be fair, they've actually managed the franc pretty successfully over the course of the last couple of years or so, really since they had to abandon the peg for folks who don't remember, there used to be this floor that the Swiss National Bank used to put under euro Swiss franc at 1.20. So it's 1.20 Swiss francs to the euro. And they defended that floor for a long time because were the Swiss franc to break down below that, which means it's strengthening against the euro, of course, it's going to dampen inflation pressures. And as everyone knows, Swiss inflation is always low. At the moment, it's far too low. Now, over the course of this year, what we have seen is that interest rates generally been drifting lower. So, it's made the appeal, if you like, or the lack of appeal of negative Swiss franc interest rates that much less of an issue. And the Swiss franc has been strengthening for some time now. And at current levels as we speak, and this cross rate you're referring to, euro Swiss, it currently stands about 1.094. I suggest that's must be about 3-4% at least below where the Swiss National Bank would want to see it. So what I think they'll be doing, if they're not already, is certainly intervention, because every Swiss National Bank quarterly policy statement, they reaffirm their commitment to prevent unwanted franc appreciation and their willingness to intervene in the forex markets. And I think it may be the case that they'll simply come out and say, well, okay, if the ECB is going to come out and, let's say, trim its refi rate by 10 or 20 basis points, we're prepared to take another 25 basis points off our policy rate, which means that the interest rate differentials will start widening again. But it's a real problem for the authorities at the moment out there.
It almost seems that it's almost becoming like part of the DNA. I mean, demand for the Swiss franc in times of trouble goes back as far as I can remember. It hasn't changed at all. It's almost like it's part of the structure of the global investment mind. And so it seemed like, well, the yen is another question. How can the Bank of Japan keep the yen from going up? What do you think?
Well, I think that's right. I mean, looking at it really, whenever you get times of turmoil in the currency markets, then you're looking at the regional safe haven currencies. Typically speaking, depending on what's going on, the dollar tends to be the number one currency. Then within Europe, it's the Swiss franc, and for the Asian bloc, it's very much the Japanese yen. Now, as you mentioned, the yen has been by far and away one of the beneficiaries of its latest bout of volatility. We're currently talking a dollar yen spot rate of just over 106. Now, I think we've talked a little bit in the past about, round about the 107 line was about as strong as the BOJ and the Japanese government would want to see it. It's now through that level, and some people are even suggesting that the dollar could weaken as low as down as 100 against the yen, which of course would be another 6% plus of strength as far as the yen goes. Now that's going to give them exactly the same problem as the Swiss National Bank. There's hardly any inflation in Japan. They can constantly miss their 2% inflation target, and the stronger yen is the last thing they need. What will they do? Well, I guess they may be prepared to intervene in the same sort of way that the Swiss National Bank has done. They may be perhaps prepared to come out and adjust their policy stance again in terms of adding to their quantitative easing, perhaps reducing interest rates yet further. But it seems to be getting to the stage now, really, when you look around that, when you're talking about negative interest rates in the first place, does a more negative interest rate have that much more of an impact on a currency when rates are negative in the first place?
Wait, I'm sorry, go ahead.
No, well, I was going to say, it does seem that a lot of this at the moment is driven by, as you were saying, is kind of trading off the back of historical themes. And if basically, we really don't know what's happening in these markets, what's safe. So Asia, it's yen, Europe, it's Swiss franc, and depending upon the global stuff, then it's the dollar.
Well, let's talk about depending on intervention. As opposed to monetary policy. Now, intervention, and help me articulate this, is that's basically a bank burning traders or burning or trying to limit sharp day-to-day moves or intraday moves. And you can do that, I think. I don't know how long you can do that, but you can burn the market here and there. But can you do it on a long-term basis? That's, I guess, my question.
Well, I suppose it depends which side of the market you're actually operating on. If we take a an economy or a central bank, I should say, which is got problems with a strong currency, then what that central bank will be doing will be looking to sell its own currency. So let's go back to the Swiss case. So the Swiss National Bank over the last few years has been active every now and again, selling the Swiss franc into the market and buying euros.
Yeah,
So
but when they're selling it, it's timing, right? They're trying to make the biggest effect as they can.
It is timing, that's right. But it's not just timing in the sense that, well, to answer your original question, can they keep doing that? Well, at the end of the day, it's the Swiss franc the Swiss National Bank that produces Swiss francs, so it can sell as many Swiss francs as it wants to in the market. That's not really the issue. In terms of the timing side of it, well, there's two aspects to this, I think. One, if we go back to when the Swiss National Bank pulled the plug on its currency target floor, 4 years or so ago now, 3 years ago, isn't that? It really caught the traders out. We saw the euro Swiss franc rate, I've got to think back now, it fell from about 1.2, so that's Swiss francs per euro, down to about 85 centimes or so to the euro. It was an absolutely huge move. And not only did that catch all the traders out of pocket, caught them out of pocket, it burnt them badly, but a number of other central banks weren't too happy about it as well because what it meant for their currencies. But it worked at the time. Traders were caught out, and we've subsequently seen until recently the Swiss franc gradually moved back up towards what the SNB's target was. Now, I think if it comes into terms of timeframes and stuff, if markets are prepared to believe that you can be caught out, so let's say if you're particularly long, so you're long Swiss francs against the euro, and you've suddenly got the Swiss National Bank on the other side of the market just spending millions of euro of Swiss francs into the market, what you're going to do? You're going to lose out. So I think a lot of it, comes down to Swiss National Bank or general central bank credibility and how they operate. Timing, as you say, is very important. Trying to get it right to have the biggest bang for your buck, or Swiss franc, or whatever currency it may be. But I think the credibility side is particularly important.
Well, it's interesting, because the U.S. doesn't have exercise currency policy at all like this. The central bank, the Fed, keeps a far distance. It's not part of their power. That's been taken, and it's the administration, the Trump administration. And it can, in the old days, you could have Treasury secretaries, Lawrence Summers or Robert Rubin, and they would talk a lot about the dollar. A lot, which would be, these vague phrasings. Yes, we're in favor of a strong dollar, very in favor, or just very in favor, those kinds of little nuances. And so you'd see, and we haven't really seen that in the U.S. yet, the dollar play, because I know you have questions about the dollar, and it's more amorphous, or it's vague. It's not as pinned down by any means here as it is in there. And we'll see if that changes.
Well, what's going to be interesting, I think, we've got the G7 summit is scheduled, I think, back end of this month. And in previous rounds of these meetings, they've all tended to pat each other on the back and come out and say, yes, everyone is perfectly happy with the idea there's going to be no form of competitive devaluation in order to boost local economies. Well, given what's been happening over the course of the last few days, when we've had the likes of China being accused of currency manipulation, we've also had the US administration, actually naming them per se, intimating that they're not happy with the ECB quantitative easing driving down the level, driving down the euro. It's going to be interesting what comes out of this meeting and whether or not we're actually starting to see some genuine fracturing of the kind of currency cooperation we've seen in the past. Well,
that's a good word, or fracturing or stress. It's not, it's not only on the central bank level, but it's also on the trade level. The U.S. bilateral. With so many countries are in the news of complaints about of fair trading, and so it's broadened out far from China, and the space of the battlefield or the field of battle keeps seemingly to expand. So and it's interesting. It's stressing out monetary policy, or it's changing monetary policy, and then its relationship to currencies is so close, and that seems to be the next shoe that falls.
I think it may well be, and I think one of the interesting aspects of this, and I think we touched on this the other week, if it really does get to a stage that we're going to pull the plug. We're not going to see any kind of competitive devaluations or anything like that. We're saying that monetary policy, well, let's be honest, interest rates can't go much lower anyway. Quantitative easing, even if central banks start going back to it, you've got to start wondering about, well, what about diminishing returns? So more and more, it seems to me, when you look at, the different means by which you can try and get an economy growing again, which is pretty well what all these central banks want to do, whether they got inflation targets or not, it comes down to fiscal policy. So I think there's going to be more and more pressure now on politicians around the world to simply accept the fact, well, look, monetary policy or even currency manipulation, if you're allowed to call it such thing, has done their bit. It's really now down to the politicians to come out and start talking about spending, such as Boris Johnson, for example, in the UK. Well, that may have been for a totally different reason.
What's the Boris Johnson news?
Well, it's interesting. What we have over here, of course, surprise, surprise, all the talk over here, and I suppose it is worth quickly mentioning, is Brexit. To mention Brexit in the intro. Markets are now starting to become increasingly concerned about prospects of a hard Brexit. As things currently stand, the new UK government under Boris Johnson and the EU Commission are completely at loggerheads. The bottom line here is that the UK government is saying, right, we need to change the previously agreed withdrawal treaty. So the treaty which actually extracts the UK from the European Union. The European Union attitude is, well, look, we've agreed this treaty. In no way, shape or form are we going to change it. So unless one side gives in a sizable way, then it looks increasingly now as if we could get some kind of a hard Brexit. Now, there's this ongoing debate, as we talked about before, as to whether or not Johnson could actually get a hard Brexit through Parliament. And the view typically there is no, there's not enough support. So, getting back to where I should be at the start of this thing, it was interesting that Johnson has been announcing a fair old swathe of public sector spending and investment plans, particularly for the likes of the National Health Service. And that has got speculation boiling away. Well, hang about, is he going to go out and call a general election? Because if he were to do that, that could give him the mandate then for the hard Brexit. And if he'd win the election, but the hard Brexit, and Parliament really would find it impossible then to stop him.
But they couldn't do that before October 31st, could he?
Well, the way things looking at the moment is I think it depends who you ask on this one. I think there's a lot of people going through the legal and statute books trying to work out whether or not he could actually do it. And certainly some people believe that if you're pretty well to try and do it now, then he could do. I mean, it's got to be said that he originally said that he wouldn't call a general election before the end of October. But this is Boris, so we really don't know.
But the European elections were just a month or so ago, and the Tories had a very small showing, right?
We did, but this is just a national election. So this is the UK popular vote. So how the UK would actually vote.
But wasn't that a near indication that the Tory support isn't that great? Or are you going to lump in the Brexit?
This is it. This is where it all gets complicated because it's the cross-party side. Yes, it comes down at the moment. If there's another election, it's people to some extent at least are going to vote on whether or not they think we should have a hard Brexit, if that's what it's going to come down to, or no Brexit at all, or a soft Brexit, whatever it may be. The Conservative Party now under Boris Johnson is the party which is proposing hard Brexit if necessary. They still maintain it's not their preferred choice, although increasingly it looks like it is the way negotiations aren't going at the moment. But they now stand for the hard Brexit. And apparently, as a result of this, the Conservatives now have increased a lead in the opinion polls into double digits. Oh, okay. So there may well be some temptation for this Tory government to try and, get some election in if they can do as quickly as possible.
Where's Nigel Farage right now? Is he in the background? Is he on television? What is he doing?
Well, he was hoping to get the UK ambassador's job in Washington, I think it was, after previous ambassador was sacked due to making perhaps some unfortunate comments about the US administration, but he didn't get that. And somehow the rug's been pulled under his feet now, because whereas he was the Brexit man, he's got his own Brexit party. Well, the Tories have really stolen a lot of his thunder, because they now, under Boris Johnson, are going down that route. Or at least the government is, even if the entire party isn't. So
well, if there was a general election, would there be his party in there?
I think his party would stand. There was some kind of talk about the possibility of the government, the Tory party, and the Brexit party operating together. Effectively, it would mean that Farage would kind of stand down to make sure that the Tories would win, and then perhaps get some kind of job within the Tory party government itself. That remains to be seen.
Oh, so he's more in the background right now.
At the moment he is, of course, since it's now Nigel Farage, you're never too sure how long that will be for. All right, let me quickly mention just other things we should be talking about. In terms of central banks, the Bank of England last Thursday. Now, as folks probably sure, they didn't do anything in terms of interest rates, but they did tweak their forward guidance on rates, which was quite interesting. Previously, they still use this central case scenario, which sees a smooth Brexit, even though it may be looking increasingly unlikely at the moment, which leads to a gradual and limited increases in interest rates over coming years as the output gap closes. What they're saying now, though, is that tightening would be conditional upon some improvement in the global economy. So again, this is going down the same sort of route as Mark was talking about the other day of the Fed, where the international economy matters that much more now, and indeed from what the ECB are saying as well. So more and more these central banks are looking at the international side of things. Earlier on today, quick change of continent, the RBA announced that will not be changing its interest rates. Its official cash rate remains at its record low of 1.0%, but they also signal apparent willingness to ease again. And later on today, we'll get the Reserve Bank of New Zealand. They are expected to cut another 25 basis points, which would put their OCR at a record low, a new record low, I should say, of 1.25%. And indeed, it looks as if it could be more to come there. Maintaining that tack, we'll get the Reserve Bank of India on Wednesday, and they're really going for broke because they're expected to deliver a fourth successive interest rate cut, which would put their benchmark rate at 5.5%. And that would be the most aggressive period of easing we've seen since the global financial crisis. So as we talked about on, I suppose, numerous podcasts in the past, the trend in interest rates at the moment is very much down. Okay, I suppose just before we go, Mark, since we should have touched on it earlier, but it's my failure to ask you, US employment report, with all this going on, it's not often people don't talk a great deal about US non-farm payroll. So in a nutshell, what did last Friday's figures tell us about the state of the US economy?
Okay, well, let me go to my Econoday calendar here and pull up the report, and it pops right in there. It was a moderate, it was moderate relative to July's very strong showing, 164,000 in payroll growth. There was a big government component in that, and that reflects the large fiscal stimulus that the U.S. is already underway in. But the manufacturing payrolls actually did very well in contrast to all the concerns about manufacturing. But what was the hidden trouble in this report were the hours, and what that hours are a major input into industrial production, and the manufacturing component of that. It doesn't look like it's going to be very strong at all when that comes out next. I think it's next Thursday, and that will be a red flag. That'll be the first definitive. Besides this, with a more definitive, more elaborated look at July's conditions in that sector. And that sector, of course, is under scrutiny right now, and is really the reason why, it's the focus of the Fed's rhetoric anyway, is to look at the business investment component within manufacturing. And so those numbers has some of those breakdowns in business equipment and things in the industrial production report for July, but that looks like it could be trouble. And if it is trouble, that could very well, for the markets, at least at that morning, raise expectations of more rate cuts to come, or at least it could raise that kind of talk. Earnings in that report showed a little bit of life, but nothing really too dangerous. Just today, which is Tuesday, we had the JOLTS report, which looks back, which lags a month. But there, it's very clear all year long an easing trend in capacity constraints in the U.S. labor market is evident. They were very extreme relative to this report, the history of this report, which tracks job openings and hires and quits, again on a lagging basis, but it builds in some detail. And that detail is showing us that there is apparently, or there may be more capacity than we thought in the labor market, which will encourage or give the Fed encouragement that their rate cut policy is the correct policy. So it doesn't look like there's going to be any flashpoint for wages or anything like that. So It's really, you had talked about slowing and stuff. Now, I think the slowing is centered in Europe. China or stagnation. China is still growing, even though at a slower rate. And the U.S. is doing really well. We had a 4.3% inflation-adjusted annual consumer spending rate in the second quarter. That's robust. So, and that reflects the strength of the labor market. So the question here for the historians will be, if these trends continue, we're going to have that domestic, insular economy versus what, for the last, post-World War II history has been this idea of raising trade as much as possible. So we're moving into a different point right now, and we'll see how important that foreign component is to a domestic component that is strong and hot and growing.
Excellent. Okay, so much to watch out there. Right, well, there we will end it for today then, and indeed for the next couple of weeks, as some of us enjoy a little vacation time. On behalf of Mark and myself, thanks as always for listening. And remember, podcast or not, you can always keep up to date with the market moves and shakers in Econoday's global economic calendar. We'll speak to you next time. Bye for now.
Econoday has provided value for the investment industry for over 25 years, amassing a comprehensive, machine-readable database of global market events. Our exceptional dataset consists of consensus, actual reported and revised numbers of economic events. Algorithmic trading firms, global banks, asset managers, hedge funds and AI technology firms are leveraging Econoday's unique historical dataset to fuel their proprietary trading models and support their research and compliance teams. Go to www.econoday.com and follow @Econoday on Twitter to learn more.